Welcome to this panel on the road to permission. I mean, the road to acquisition. Acquisition is an important thing in a company's life. It gets that far. So I'm Howard Morgan, partner at First Round Capital, and I'll quickly introduce our panelists. I'll have them tell you a little about themselves in a minute. To my right, we have Lori Goldberg. With Traffic, which has been acquired by Thales. We have Joe Fernandez, founder of Clout, which was acquired by Lithium. And we have Josh Albertson with Vox Media. He had been with Curved, which was acquired by Vox Media. So we have a bunch of people who are pretty knowledgeable about the process. And I've got a bunch of questions that I will throw out and discuss, and then we'll also let them each tell you a little bit about their process of getting acquired. And then we'll have some time, hopefully, for you guys to ask some questions along the way. First, I wanted to point out that New York has been a pretty good place for to build companies that get acquired. At First Round, we've done about 280 investments since we started in 2005. Only 3 have gone public. So almost all of the exits we've had, and roughly 60 plus exits, have been acquisitions. And if you're building a company, the chance that you get it to the point where you go public is pretty slim. So one of the things you have to think of as you're building it is, if I need to get acquired, if I want to get acquired, or if someone comes at me with an unsolicited acquisition offer, how does that work, and what do I need to think about when I'm getting ready to do it? So in New York, we had big acquisitions in the first bubble, which I was around for. We had DoubleClick, which got acquired by Google and formed the basis for a lot of Google's success. Google New York started out pretty much as the DoubleClick operation with a little bit added on to it. We've had First Round's company Invite Media, which sort of created demand-side platforms acquired by Google. We had more recently, Yahoo acquiring Tumblr for almost $1 billion. Pretty nice acquisition for a New York company. MakerBot here in Brooklyn, acquired for $400 million by Stratasys. We had in New York another company called Single Platform, acquired by Constant Contact. So it's been a pretty fertile area for both big acquisitions like those and also really small acquisitions, somewhere from the acqui-hire on up. And in each case, for those acquisitions, some of the companies were more ready than others to be acquired, and some of the acquisitions fared better than others post-acquisition. And being ready for all that is something that you want to think about. There's a pretty horrifying McKinsey study which shows that something like 75% of acquisitions don't work, in the sense that they don't really make money for the acquirer. And yet, in what's called the triumph of hope over experience, people still acquire companies and people still start companies, because that's another area where the odds are not necessarily in your favor. But we're fortunate in that we do have a lot of companies where the odds work out and they get there. So we'll talk a little bit about how that's happened. So what I'd like each of the panelists to do is to start by telling you a little bit about themselves and what company they were in as it was built, and whether or not they were the founder or not, how it was built, and then a little bit about their acquisition process by the acquirer that took them. So let's start with Lori.
Hi. Hello?
Mike too, yeah.
Awesome.
I think you're okay, yeah.
It works.
Yeah.
Okay, so I'm Lori Goldberg. I am the CEO of Traffic. Traffic is a digital ad agency. Traffic started out as a technology company, and we sort of pivoted into the service organization, which is pretty rare. Most of the time it's the other way around. You start off as a service organization and you build your own technology. So our acquisition was a little interesting, and I'm happy to talk you guys through that. I have always been on the agency side. In my former life, I was at Razorfish, and before that I was at Initiative, which is part of IPG. So always large agencies, large client life, and Traffic just focuses on the digital space. So like I said, when we pivoted from a technology company to an agency, that's when I got promoted to CEO, and about a year afterwards I took the company to acquisition. We got purchased by Thales about a year ago.
Cool.
Okay.
My name's Joe Fernandez. I am the co-founder and I guess formerly CEO of Clout, now general manager of Clout. We were acquired just like 60 days ago, so it's all super fresh and kind of still going through it. I actually started Clout here in New York and moved it out to San Francisco like 4 years ago. Yeah, that's what we're doing. So.
Cool. I'm Josh Albertson with Vox Media. I was one of the guys who built Curbed, which publishes Curbed, which is a real estate site, a restaurant and nightlife site called Eater, and a fashion and retail site called Racked. So we were purchased in November of 2013 by Vox after a period of time where we were considering raising some money, trying to get bigger, and ultimately found a really good fit with Vox.
Okay, so let me ask a question for each of you to comment on, which is, did you build your company, or Lori, when you joined your company, with acquisition in mind, or did you build your company with the idea that, oh, someday we're going to go public, or someday we're going to be generating gobs of cash and giant profits?
I don't think there's anybody in our space that doesn't think they're going to be the next Google, or at least pretend that there's a way to get there. So I would say that there was a couple of options for us. It's either raise money and continue to go on and generate a healthy profit, or figure out who wants to buy us. And when I joined the company, like I said, it was a technology play. I really drank the Kool-Aid and thought that we had a differentiator in the marketplace. And the very first question I asked on my interview was, what's your exit strategy? What do you have in mind? And they rattled off, oh, well, Microsoft might buy us, or Adobe might buy us. I'm like, oh, this is great. But the reality is, there has to be something that people want, and what people found attractive about Traffic was that we were a cohesive digital group. And a lot of people do what we do. I'm not going to pretend that there's no differentiator or that there's no competition in the marketplace, but a lot of people don't have a digital group that only focuses on digital and only focuses on media. So I guess to answer your question, that is something that we were building towards, creating that unique capability. And people that found us attractive were people that weren't in New York, that wanted to get a presence in New York, or companies that bought or sold radio, TV, print, but just needed a digital group, or somebody that said, hey, we're a creative agency, but we don't have a media buying arm. And so all those things, people found us attractive in that capacity.
Mm-hmm. Joe?
I think it was a pretty fluid process. When I was deciding, I had this idea of Clout, I built a little prototype, I was getting obsessed with it, and I had to make a decision of, do I quit everything else I'm working on? And I thought, what is the potential of this? Could it get acquired? And I remember the horizon of what I thought would have been amazing was, maybe I could build this into 5 or 8 people, and Twitter will buy us for $5 million. And that was oh my gosh, let's do it. But then that starts changing, and you have these kind of forks in the road and decision points every time you raise a round of money, every time somebody comes in unsolicited, and you have to decide what kind of company am I building? Am I building something forever, or something that gets to a certain point? We raised almost $50 million. We were going for it. And that became pretty early on a conscious decision. It was, we were going big. And so there wasn't really ever an idea of selling. It was kind of a random thing that surprised us when it happened, actually.
Okay. Josh?
For us, Curb started as what the founder Lockhart Steele calls an aggressive hobby, and this was back about 10 years ago. And so we were all basically doing it outside of our day jobs, and weren't really thinking about very much on the other end, just having a good time and trying to make something work. We raised some money in 2007 from a group of strategic angels, and I think that once we raised that money, we knew there would be some sort of liquidity event down the road if we were successful. But the period after that, 2008 to 2010, if you remember, was sort of just a survival period. So we really weren't thinking too hard about whether we were going to go public or be acquired, just whether we could keep the lights on. And then in the sort of, once we came out of that and had a business that was profitable and growing, we knew that down the road there probably would be some sort of acquisition.
Did the investors, the venture investors, play a role in the acquisition process, and was it positive or negative? I know at first round we do play a role when that happens, and sometimes the founders think it's positive, sometimes maybe not, although we hope they usually do think it's positive. But how did it work out in your cases?
Yeah, so we raised a lot of money. We raised about $25 million before we came to the decision that we should probably put the company up for sale. They were heavily involved in the process. I didn't know what I was doing. For anybody that's never gone through this, it's not fun. It is fun, but it's a crazy ride.
It's fun for a few days.
It's fun because you're like, wow, they want to buy us? Great. So kind of going through that, and then the due diligence process is equally as fun. And so I would just say that without the support of the VC guys who've been through this time and time again, unless you personally have gone through it, it's hard to know what the next steps are or what's normal. We had a great team of lawyers. We had a great team of VCs. I Googled some stuff to figure it out. But we didn't have an investment banker. So that, good, bad, or different, that's just what happened.
Joe?
So our VCs, we have a lot of VCs, so it's, again, a range of emotions kind of dealing with. There was like one or two that were MVPs that like this deal wouldn't have got done without, that were able to help us kind of, maneuver or just deal with the ones that were a little bit more difficult. And so I wouldn't say, the deal wouldn't have got done without the help of VCs. It's, I think, a good way to leave it.
Okay. Josh?
Yeah, our case was a little different because we didn't raise institutional money, so I think probably the pressures in the process were a little different than what you guys went through. Certainly they were supportive, and I think the best part was that sort of feeling that the decision was ultimately in our hands in our case, and we wanted to sort of make them feel like they had gotten their money's worth, and I think they did. We weren't not the same set of issues to be dealing with a $1.5 million raise from a group of smart angels.
Mm-hmm.
There's a lot of stakeholders too involved, right? So I think that the biggest obstacle in that is navigating. So there's new company that wants to buy you. There's current management team. There's the fiduciary responsibility of the company. There's your employees, and then everybody on the board. And what I kept saying throughout the whole process is, anybody at any given point can hit this big red button and stop it. But so depending on who was looking to buy us and what offers were on the table were beneficial for any one of those parties, but not necessarily all of them. Mm-hmm. So to find somebody that satisfied all of those people and nobody hit the red button, that was a good thing for us.
Mm-hmm. Well, one of the things in the process that we've often seen is that the acquirer plays off management against the investors, and the considerations offered are X dollars, X shares, and then for you guys who are going to stay, there's this other sweetener. How did that work in your cases?
I guess I have a funny one because we acquired a couple companies and
right.
We did that. Personally, I don't care about their investors.
Right.
They're not going to be the ones building our company. Mm-hmm. And I definitely saw it when we went through our acquisition. They tried to do the same thing. Ultimately, didn't really work that way. And I think especially at the amount of money we raised, our investors weren't really playing that game. But it definitely happens.
Yeah.
I think we looked at that. We were trying to get a fair deal for what we'd done to date, and then anything, what we agreed to from the acquisition forward was going to be for what we were doing for Vox after the fact. So that's how we tried to view it.
Right, but that Vox sees the total compensation package, and so whoever it is always sort of dividing it up. And
that's how I square it in my head.
Yeah, it does.
You definitely feel responsibility to your investors. First responsibility is to the team, the employees, but the investors. you do get a lot of pressure when you go through that acquisition process of screw them over, and they'll also pull you, so you get screwed over. So you got to find the right balance where everyone is a little unhappy in the end.
Yeah, of course, this is for the venture capital side. This is not a single point game. We play this game over and over, and so we want to make sure that founders are comfortable with us to come to us with their next company, and founders have to do it in a way that the venture capitalists are willing to fund their next company because they don't feel too put upon in the process.
Yep.
Yeah, that's.
What key things might you have done differently along the way if you knew you were going to be acquired? What would you do sort of 2 years out or a year out that you didn't do that you would have liked to do?
For us, there wasn't anything particular about the acquisition process that felt like it needed to be done over. I think in some respects when we got to, Curbed had been around for long enough that we sort of, we were going through a process where we were going to raise money or ultimately sell a company. And I think you get to a certain stage of your life that you are what you are, and the story that you tell is sort of difficult to change after a certain period of time. So I think maybe we would have taken some bigger swings early on, but of course building brands takes a long time. And I think in retrospect, we made most of the right decisions. But if you're going to go big, you have to do it early. It's a tricky thing to decide later in the game.
I would say from a very tactical perspective, make sure your books are in order. When I always say I inherited it, so it's not really my fault, but it's a lot of work to make sure that everything is in row so that the process goes a lot smoother. But I would say from a top line perspective, I'm a leader that's extremely transparent to my team, and almost too much so. So as we were going through the process, I let everybody know exactly what we were doing, and I lost some people along the way. So we're a service-oriented business, and our team is half of our battle, and people want to buy the existing team, and if our team is walking out the door because they're not sure what's happening, it's because I'm telling them I'm not sure what's happening. So if I were going to do anything different, it would probably be a little less transparent. However, having said that, on the flip side, the team that stayed with me is really loyal, and I can't thank them enough for that. And yes, they were rewarded monetarily, but also they saw the bigger picture. So I go back and forth whether that was the right move, but that's who I am, and there's nothing. I would probably do the same thing again, but I would advise everybody else not to.
Yeah, it's tough to think about what you would do a year before you maybe get. You're in a sale process at that point, and you're. I don't know. That was just very different. We were like heading towards break even and growing the company. So. I think it's just different if you're like thinking about selling, then you start getting your books in order and things like that. But I can't really think of what we would have done specifically differently.
I mean, the books in order point is a good one, and sort of the broader idea that you should always feel like you're ready for that moment. That if somebody knocked on your door, you sort of had already cleaned up your house, and so I think that we tried to approach things that way, and it doesn't always work, obviously, but. To the extent that you can sort of live every day like it's going to be your last at the company, I think that's a nice way to go about it.
We've been encouraging our companies to get not only good financial records, but also to actually get audited very early in the process. Because if you're going to be bought by a public company for a significant sum of money, they're going to need audited financials. And if you don't have them, it's going to add 6 to 9 months to your process of getting acquired. And 6 to 9 months is a long time to be in that kind of limbo of being an acquisition. So, Lori, I think I would agree completely. Do that as a matter of course all along the way. That shouldn't be in anticipation of. It just makes that if it ever happens, it just makes it happen much quicker than it would happen otherwise. The other thing we see people, the question is sort of, do I try to push to break even? So I'm a profitable company, or do I try to get user growth, or do I grow some other KPI that I think will attract people? And how did you work those kind of things? 'Cause you sounded like Josh, you were going to get to break even so you could return money, or.
Yeah, I mean, we got to break even in 2009 really out of necessity, because the market was sort of closed at that moment, at least to us, and so we had to get really lean quickly and sort of figure out how to be a going concern. But that, as I said earlier, that sort of creates a double-edged sword, because then you're sort of it's trickier to invest to stay ahead of yourselves if you know that you're subject to whatever cash flow is coming in. So that early break even, while it gave us peace of mind and allowed us to get bigger, and over the long term sort of may have hindered some of that short-term growth, I think.
Yeah, one final comment on the audited financials. Sure. I remember arguing a ton with our head of finance, like, why are we wasting time on this? This is distracting, it's a headache. And it totally saved our ass when we were doing the deal. Like, it wouldn't have happened without audited financials. So that was definitely a lesson learned. On the what to focus on, just focus on something that looks like it's going up and to the right, whether that's revenue or growth or some story you can tell, because it's going to be the same whether you're going through an acquisition or a funding. It was one of the things we struggled with was we had a two-sided platform. We had consumer side of our business that most people just know about the cloud score, and then we had a revenue side where brands paid us. And my investors would say, it looks good, but I don't know how to tell if this is actually, how good you guys are doing, because we were growing both users and revenue, at a pretty reasonable but linear pace. And I don't want to say VCs are dumb, but they only get the up and to the right, exponential growth, and acquirers are the same way. They drool over that. So get something looking like it's moving, and you'll have a better negotiation.
Smart.
It's certainly true that we are one-track minds like that. Yes, we love those hockey sticks and slow and steady growth, which may win the race in the business long term, is not necessarily.
Yeah, showing 5 metrics that are all growing steadily doesn't add up to exponential. So.
Exactly. I know, Laura, you said you didn't use a banker. Was that a conscious decision? And for the others, if you did, why and who, and how did that interaction work? And would you recommend it?
It was a conscious decision because, quite frankly, we couldn't afford it. But I probably would have. So I've been in this industry for 20 years, and once people found out that we were for sale, or we were interested in some kind of an M&A, I probably did more breakfast, lunch, dinner, drinks, after dinner drinks, and after dinner drinks than I ever want to do in my life. And it just started happening. And so as you start forming conversations with people, they're like, hey, we're not interested, but so-and-so might be interested. And there was definitely a unique set of characteristics, and I'm sure that banks won't agree with me, but I knew those relationships more than they would know them. And so what I really needed was a strong lawyer and a strong mentor on the VC side. Then I needed a strong banker to help us through that.
Yep.
Yeah, we also did not use a banker. I felt comfortable with the people I had on my team, that we could work through the process, and we were having the outside conversations we needed to have, and so we made that decision.
And Josh?
Yeah, we did hire a banker, and I think it was mostly to sort of organize the process in the absence of other institutional financial people on board. So, in that respect, I think it was really good for us. But, as Lori and Joe both said, that it really comes down to your relationships and what you know about your business. So it certainly wasn't we had good bankers, and I thought they did a lot of really smart things, but in the end, you really have to do all the hard work, and so there's no magic formula there.
I think our perspective at First Round is there's 2 possibilities for a company, and one is to be bought, which is to say a lot of people want you, and you probably need a banker less in that case, and the other is to try to be sold, which is you're trying to raise money, it's a little difficult, you say, well, maybe we should also think about selling the company, and then you need some way to get at the broadest possible set of potential buyers. some of whom you don't even think about. Rakuten in Japan has been buying U.S. companies. Singtel recently has been buying U.S. ad companies. So these are people you may not have relationships with, but they're buyers, and they may even be buyers who are overpaying, which is what you certainly want as a founder or a VC, because they want to get into the market. And those are the kind of situations where I think a banker can help the most. They can get more quick access to a lot of companies that you might not otherwise quickly get access to. But in general, if you're being bought and the people are coming at you, then there's much less need. The need comes mainly to make sure that there's more than one potential buyer, so that the terms are not dictated completely by the buyer.
That couldn't be more true. So we had a couple of people that were saying, "Oh, we want to buy you at this, and we want to buy you at this," and again, I'd say there was 5 or 6 different stakeholders, and they were good for certain people, and then these guys came in and they're like, I'm like, okay, you're it. So I mean, it just helps to have other term sheets on the table that sets a base level, and then the negotiation gets easier on our end.
Mm-hmm. In terms of negotiating for your team, and in terms of how long they would stay, had to stay, etc., how did that work with?
So Vox took all of our employees, which was really great, and they essentially just wanted employees to sign I think it was 75% to sign contracts that they would come along. There was no requirement that anybody stay for a particular period of time, and that was true for management as well, although we've sort of made commitments in other ways. So all in all, I thought it was a really generous way to handle the situation.
Mm-hmm.
Yeah, ours actually was similar in the sense everyone got offered. I think everyone, maybe one person didn't go, decided not to, and no like lockdown in terms of. I don't think that's good for either side. Having employees, whether it's the management team or whoever who's only there because they have to be there, isn't good either. So we were able to not have to do that.
Mm-hmm. Yep. What other key learnings did you have as you went through the process? Because I think in all of your cases, you sort of started out saying we need to raise money, and one way to do that is to be sold, is to be bought by somebody who has the money that we need, and the other is in the process of people hear you're raising money and they come and they see the financials sort of leak out, because it's rare that the financials stay completely confidential in these transactions. So any other learnings along the way?
I learned I would make sure you know what email system they use before you do a deal. We just had to switch from Google to Outlook, and that really stunk. No, but
Would you not do it again?
no, I would not do it, but it is like the
painful
complaint of the moment in the team. I think it really, to the extent you can focus on building a business and have success and have them come to you because of that, the better off you are, obviously. I think as a CEO, it's a key and underrated skill of your job is to kind of cultivate options in a way that's non-distracting, which is actually hard to do because you don't want to have your team trying 50 different things or doing 50 different biz dev deals, and so that you have options. And making those options is how much you raise, what valuation you raise at, who you do your strategic biz dev deals with, how you portray yourself in the media. All that is about creating optionality and being able to do the right level of that, but not overwhelm or distract the company from its main mission, is something I learned kind of later in the game that I think I would try to do better next time.
Were you as transparent internally as Lori had said she was with what was going on?
Yeah, especially the day I walked into the office and the deal was up on everyone's screen because it leaked. And it got transparent real quick. I literally was speaking at a conference, and between the time I walked the 4 blocks from that conference to our office, the deal had leaked on Recode or somewhere, and I walk into the office and it's on everybody's screen. and it was like 48 hours after I signed a term sheet. So there was like so much in the air. I didn't even know, didn't know if this was going to take 60 days or 120 days to close, or like what was going to happen. And so no one knew. Like maybe one or two other people in the whole company knew. My sister works in the company. She didn't even know. My parents, like nobody knew. So then it was like, all right, guys, all hands. And then it had to get very, very transparent.
Did you find the leaker?
I have ideas, but I don't.
That Kara Swisher, it really works hard to find stuff out. What about Josh? Did you guys have a leak or?
No, we kept it pretty quiet. We never told our employees anything, so it worked out just fine.
Uh-huh. Let me go out to questions if any of you guys have any questions. Yeah.
What kind of technological changes did you guys have to make, if any, after, I guess, post-acquisition? Especially for digital, like, are you guys using Glassdoor CMS or?
Yeah.
So the question is, what kind of technological changes did you have to make after the acquisition to fit with the acquirer's systems of various kinds? So, Josh?
Yeah, one of the reasons we like Vox so much is they have all this platform technology for a media company like ours, and we didn't have that. So that's certainly part of the process for us, is getting all of our sites onto their platform, which is fantastic. Like Joe, we migrated email systems, but we're still on Gmail, so everything's fine. But otherwise, they're a like-minded sort of company cut from the same cloth, so nothing too painful.
For us, broadly across our platform, that was one of the big things they wanted us for. Just from a technology standpoint, we were really far ahead, and they're adopting most of our stuff in our platform, so it's cool.
Except for Outlook.
Except Outlook.
Ours was to get more into the digital space. They own a bunch of old school sort of yellow page business models, and because we're in the digital space, it went the other way. So other than our benefits getting better and some HR stuff, it's been a pretty smooth transaction.
So when I was chairman of Internet Brands from 2000, and I was chairman all the way through, but from 2004 to 2008, we did 140 acquisitions. But almost all relatively small acquisitions. We bought every auto forum available, and they were all acquisitions in the $1 to $4 million range. And we kept the editors, and we moved everyone onto the platform that we had built. And if they had a great salesperson, which most of them didn't, but we kept them. But it was a huge change, and it was a different kind of acquisition. We were acquiring content and user base. And the same thing is also true a lot of times of the big acqui-hire thing that goes on, probably slightly more in Silicon Valley than here, where companies want to acquire engineering teams that have worked together. And so, and the models that we see, Yahoo by and large, and Google by and large will say, how much money was invested? We'll give the investors their money back, and we'll take the team, and we'll incentivize the team going forward. And those are sort of different scale acquisitions, but are in fact much more common acquisitions as companies are going through difficult times, and yet everyone wants to come out with a nice piece of PR saying XYZ was acquired by Google, terms not disclosed, and that it's rarely that when Skybox gets acquired, it's $500 million, that's disclosed. When somebody small gets acquired for basically $1.2 million, which was their seed round, and some options for the employees, terms are not disclosed. So we see both of those things happening. Question? Yeah.
How much time did you spend on that transition plan?
How much time do you spend on a transition plan?
We didn't spend. We did it kind of in real time because the deal leaked, and then everyone got so focused on getting the deal closed that then it was closed, and it was like, oh crap, now what? So we kind of like transition planned in real time.
Yeah, same.
Go ahead.
The same here.
I was going to say we're a little different because traffic as an entity stayed the same. We just got bought by a parent company that has other assets. So my day-to-day life, other than I can now actually focus on my day-to-day life instead of focus on M&A, was the same.
We've sold a lot of companies to Google, Apple, Microsoft, Those companies focus a lot on the transition plan beforehand. They said they have teams that come in and do that. So if you're selling to somebody really big, then you will have a lot of focus on that. They'll interview every employee. They'll figure out where they're going to fit, if they are going to fit, work the benefits out. With Apple, of course, they'll get the security briefings and all the other stuff that goes along with being at Apple, and then you never hear from them again because they're not allowed to talk to anyone. So there is a lot of that, but we only see it happening with those sort of giant acquirers, the very heavily corporate acquirers. And I include Google in that, even though their culture is supposedly a little bit different. But in the acquisition side, they do that.
Hi. I run a company in cross-device identification on advertising. And we're in the process of raising Series A. But at the same time, we also notice a lot of M&A activity. So a lot of companies are approaching us. So quite a luxury position. How, any tips in walking both ways?
Should he raise money or take the acquisition offers, I guess is the question.
You should weigh all of your options, and it changes every day. What you think you should do next. It's a balancing act. Just seriously, every day you're like, okay, now I'm focused on this. Oh wait, hold on, this just came on the table. And you got to figure out what's best for all of your stakeholders, yourself included, your team, your investors. You just got to figure out what's going to work for the majority of them.
Yeah, if you can, having optionality again is key, and is the best thing you can have in your back pocket. So, you can use both of those against each other, and then ultimately, though, you have to make a decision of how confident you are that, because when you raise that round, you just set a big bar you got to jump over. So,
Yeah.
I'd cash out now.
I mean, we see that we see this all the time, and I think the differences are along two sets of lines. But one set is, does the founder have any personal wealth already? And if they do, then they're more willing to go longer and look at taking that investment, which then requires them to deliver a 3x or more on that investment. So if you've got an acquisition offer at 25 million and you have the ability to raise 10 million at that 25 million, if you raise that 10 million, you need a $100 million exit, right? And you may not be given the dilution. If you don't get that $100 million exit, you may not be better off until you get pretty far along the way there. So if it's your first time, and this happened in several of our companies where the founders exited what we would think of as early from the venture capital point of view, but it was life-changing wealth for them, and then we backed their next company, and we've done that several times, and we're perfectly happy we'll go along with whatever the founder wants in those situations. But we talk about the decision to stay on the local train and have more optionality, and Joe put it just right, or to get on the express train where the next stop is 42nd Street, and you're not getting off anywhere in between. Because you can't, because it'll be a loss for the investors and for you. So you have to decide what you want to do there. And to put it more succinctly, as Josh said, take the money. No. Yeah.
No, I think you said that exactly right. Not the last part, the first part.
More questions here? When the multiple offers came in, what factors other than price did you really focus on? Because price is obviously a dominant factor in some ways, but not the only one.
I know I've said this a couple times now, but there was literally 5 or 6 different stakeholders,
right.
And so you had to appease everybody. Vision was important for the management team and the existing team, and who's going to keep the culture and the vision of what we were trying to accomplish and what we're doing. That was important. It's kind of a softer measure, because at the end of the day, price beat all that. Do they want to take the existing team? That was important to me. I felt like they stuck with me, and now they're gonna fire everyone. That's not gonna be possible. So there's a couple factors, but yeah, ultimately, price is a big deal. I think for the financial guys and.
Mm-hmm.
Yeah.
Go ahead. Sorry.
So, I agree. All the sort of so-called soft factors are really important. But as a subset of price, the cash equity mix can be really important, especially when it's a private company buying you. Sort of figuring out how long you're willing to buy into what they're doing, and maybe you're not going to be liquid for a while. That can be a serious consideration.
We actually spent, the CEO of Lithium who acquired us and myself spent the most time talking about values. We clicked really quickly on having the same vision of where we thought the world was going. The math was relatively easy in terms of like what it would take to get a deal done. There were a lot of questions about the split and how it's distributed, but you could work through that. It was really, all that stuff doesn't matter though if you don't share a value set that's going to let you build that vision you share moving forward and reach that outcome you're doing the deal for. So we did like a trip even together and went away from San Francisco and just spent like a bunch of time talking about like, how do we think about building teams? How do we think about building products? What's important to us? How do we handle certain situations? And I thought that was critical, and I mean that was the only way. Without that, I couldn't imagine getting comfortable and doing the deal and the scenario we were in.
The other thing that occurs, I think there's a real dichotomy between being bought by a company kind of in your space and being bought by one of the giants. Because when you're bought by one of the giants, you're being bought by, right now, one or two people in there who think they see some vision for how you fit, but they're going to be moved off of their jobs pretty quickly. Whereas if you're bought by another founder, they're likely to be there for a few years. So you have to think a little bit differently about how you would fit into a giant company and what they actually want from you. And that may be a different kind of cultural fit. Have you seen any of that? You've seen a lot of friends out west get acquired.
Yeah, I mean, I've definitely have friends whose companies get acquired and they're miserable, and the teams are all gone, and because they didn't spend time on that, and then you definitely you're right. Like in the bigger companies, it's some product manager and corp dev person needs what you do to fill a hole, but like the strategy, the winds could shift so quickly, and you're lost in this big sea of an org. So we were also again unique in the sense that we make up almost 25% of the combined entity. So we're literally like changing. We're creating a new culture together with that much density that we brought to the equation.
Mm-hmm. Any more questions? I mean, we often, when our founders and our companies get bought by the very large companies, the first thing we do is put the 100% vesting date on our calendar for those founders, or actually 6 months before that, so that we can make sure we stay in good touch with them. Because the fraction that leave those companies after those first typically 12 or 24 months is in the sort of high 90s. If they really are founders and have a founder mentality,
creator.
Yeah, if they're creative, it's very hard to stay within a large organization, and unless you're given that creative freedom, and very often they're not given that creative freedom in those companies. So acquisition is only one route, but when it works, of course, both the founders and their teams and the investors and everyone has that liquidity event. Everyone can pop some champagne and enjoy that and go back to work, and then a few years later create another one. And that's exactly what we in the venture business live for. We love serial founders, serial entrepreneurs who come back to us time and again. We funded one entrepreneur 4 times. Fortunately for us, one of them was Uber. One of them was another big success story. So we're very happy to see companies get sold because we get the liquidity, but even if it's earlier than we would have liked, we may get another deal later on that could be even better. Who knows? All right, I'd like to thank the panel. I think we've got to our time. Lori and Joe and Josh, and thank the audience.